discounted cash flow method. Discounted cash flow method. So my question to all of you is, why to use discounted cash flow method? Everyone, why to use discounted cash flow method? Everyone.
To get the present value of the earnings.
Okay, okay,
Because we are taking a decision today.
okay.
So buyer has to take decision today.
Uh-huh.
That's why we need to value it today basis.
Okay, very good, very good, very good, very good. My next question is, why to use two-stage discounted cash flow method? I'm sure all of you by now would know that invariably, in case of the discounted cash flow method, we use the two-stage discounted cash flow method. And my question to all of you is, why do we do that? Why do we do that?
What is this two stage? I do not understand.
Okay, right. Okay, all right. So no worries. I'm going to explain that to you. I'm going to explain to you. Okay. So please remember, first of all, I have explained to you as to why do we use the discounted cash flow method. First, we use the discounted cash flow method for the purpose of valuation, and that is because we are trying to find out what is value of a company. What is value of a company? And what is value of a company? A value of a company is nothing but total of its future earnings. What is value of a company? It is nothing but total of its future earnings. But future earnings, we understand that the value of money changes with the passage of time, and therefore we cannot take the future earnings on the absolute basis. And so how do we convert those future earnings in terms of present value? And that is by discounting them. And that is the reason why do we use the discounted cash flow method. Now the question is, why do we use two-stage discounted cash flow method? So first of all, let us understand as to what is the two-stage discounted cash flow method. I am sure all of us are aware that in the corporate, the companies that we have, theoretically, companies can have two kinds of life. Number one, a company can have a finite life. That means what? That means a company is started with a clear mandate that this company will be in operation for 5 years. After 5 years, this company will be closed down. Now, theoretically, this can happen, but practically, it does not happen. Practically, what happens? Practically, when the companies start, they start with an infinite life. They start with an infinite life. And under the discounted cash flow method, what we have to do? We have to discount the future cash flow. So please pay attention. If I was to do valuation of a company that was having finite life of 5 years, 7 years, 10 years, 20 years, then calculating the discounted cash flow for all these years is not a problem. Is not a problem, because I can just project the cash flow for next 20 years and the discount it with my cost of capital and arrive at the present value for all those 20 years. Total them the total all the present value for the 20 years, and whatever is the total, that becomes my present value, or that becomes value of that business. But there is a problem. And what is the problem? The problem is the companies do not start for 5 years, 10 years, 20 years, 30 years, 40 years. Companies start for infinity. Now, if companies start for infinity, then how to calculate? Then how to calculate the future earnings for the infinity? How to calculate? Because it's infinity, so it will go on and on and on and on, and no Excel model will ever let you calculate for infinity, because infinity means is not ending. So how to resolve this problem? This problem is resolved by using two-stage discounting model. So what is two-stage discounting model? Two-stage discounting model is, you break life of a business into two parts. And please pay attention. You break the life of a business into two parts. The first part is known as explicit forecast period. The first part is known as explicit forecast period. That is the period when you know and when you think that company will have extraordinary growth or high growth or super growth, and that is the explicit forecast period. Now this period is not going to last forever. This period will last for 5 years, 7 years, 10 years, 12 years, 8 years, 3 years, like that. So, whatever that may be, let's say for example, for a company whose valuation we are doing has a high growth period of 5 years. So, this 5 years period is referred as explicit growth period. And let's say for example, during this explicit growth period, company is going to grow at a high super growth rate of 12%. And then after 5 years, what will happen? The company's growth will stabilize and it will grow at a rate of, let's say, 7%. So 12%, let's say 12% during the high growth period and 7% during the normal growth period. So the first period of 5 years is known as explicit forecast period, where the growth is going to be at the rate of 12%, and where this explicit growth period stops, from there the second period starts, and that period is known as terminal period. That period is known as terminal period, or it is known as continuing period. So under the two-stage discounting model, the evaluation is done in two stages. Number one, you find out the value of the explicit forecast period, and then you find out the value of the terminal period, total them together, and that becomes value of the business. So friends, this is what is discounted cash flow method, and this is why we use the discounted cash flow method, and this is why we use the two-stage discounted cash flow method. Does it make sense to every one of you?
Yes.
Everyone?
Yes.
Yes. Okay, very good. Very good. So let us move forward now. How to calculate this present value, or how to calculate the value of using the discounted cash flow method? Let me share with you a little more information about this. So now you can see, firstly, what we have one component, that is D. Now DT is, D stands for the cash flow. That cash flow, remember, can be free cash flow for the firm, or it can be free cash flow for the equity. And then what you have, and the T stands for the period of the explicit forecast, right? So first you will calculate the value for the explicit forecast period, which is DT. T is the time period. Then what you will do, then your terminal period will start. Then you will have terminal period starting, and how will you calculate the value of the terminal period? You will calculate the value of the terminal period by finding out the cash flow for the period of n plus 1, and then dividing it by the cost of capital minus the growth rate. So that will give you the cash flow for the terminal period. We will see it with the help of an example, and then you discount it. And the total of both these components, that is stage 1 and stage 2, becomes your value of the business. So this is how we calculate the value using the two-stage discounting model. So please remember, discounted cash flow method will have always two-stage discounting model. Theoretically, discounted cash flow method can also have three-stage discounting, or four-stage discounting model. That means what? That means it can happen in case of a company, theoretically speaking, that company first grows at the rate of 15% for 5 years, then for next 3 years it grows at the rate of 10%, and then for 2 years it grows at the rate of 9%, and then terminally it grows at the rate of 5%. So, but remember, the stages may increase, but the methodology of finding value of this company will remain same, as we have discussed just now. So that is how it is, and then let's go forward. So this is your The first thing that you see here is your capitalization, and second thing that you see here is your discounting. Now friends, let me share with you process of business valuation using the two-stage discounting method. Now, I would like all of you, I'm sure all of you would have, uh, done some reading already. So I would like all of you to tell me in few seconds as to how do you think the discounted cash flow method works. What are the different steps that are there in using the discounted cash flow method? Over to all of you, and I want every one of you, so you are 7 of you, so I want all the 7 of you to answer this question one by one. Tell your name and give me the answer.
Sir, my name is Sachin.
Mm-hmm.
Sir, in case of discounted cash flow method, we have to ascertain the
Okay.
cash flow over a period of time.
Okay. Yeah.
My name is Shyam, sir.
No. Let him finish. Sachin, your answer is not complete.
Sir, step one is that we have to ascertain the cash flows over a period of time. I suppose it is complete.
And then what do you do?
Then in next we will discount it.
Okay. And how do you discount, Sachin? How do you discount?
We will
Okay. Next. Next.
My name is Shyam, sir.
Yes, Sham.
Yeah, we will calculate free cash flows from company a certain period,
Very good.
and here we will determine that terminal value.
Okay.
We will discount using that cost of equity to year 0.
Mm-hmm.
That is the company's.
Mm-hmm. Okay, very good. And then? Okay, good. Next. Next.
My name is G.K. Jain.
Yes, Jain sir.
We have to evaluate the valuation of two periods.
Two period, yes.
One is for high growth period, one is for declining growth.
Mm-hmm.
Okay, static growth. So for the high growth period, we have to value on actual basis. We have to derive the DCF.
Mm-hmm.
On DCF, we have to ending. Then we have to come out with the discounted value of the 5-year growth period.
Mm-hmm.
Thereafter, we for the declining or the static period,
Mm-hmm.
the projection we have to deduct the factor will be deducting the ratio of the forecast period.
Mm-hmm.
Then we will come out with the actual value of that static period valuation.
Okay.
Then we have to add up.
Okay. Okay. Very good, Jain sir. Very nice. Very good. Very good. Next. All of you have to answer. No choice to anyone.
My name is Sunil.
Sunil. Yes, Sunil, please.
So first we need to identify the peak period for how many years the business is in peak,
Mm-hmm.
and next we need to calculate the terminal period.
Mm-hmm.
And next, as Sian said, we need to calculate the cash flows,
Mm-hmm.
and then we need to discount the future cash flows with the cost of equity
Mm-hmm.
or the inflation index.
Okay.
So we need to bring down to the present value, and that's it, sir.
Okay. Very good. Next. Next. So we have only 4 people who have spoken. Where are the remaining 3? Are they there or they are not there? So this is attendance also, by the way. So those who don't speak, they will not get the attendance. Okay, so looks like they are not there. So they don't get the attendance in that case. All right, friends. So very good. I think all of you have really spoken very well. And let us understand, friends. Let us understand how the discounted cash flow method works. And as I said earlier, and I'm repeating it purposely, we really have to be absolutely thorough as far as the discounted cash flow method is concerned, because in the finance world, it is the discounted cash flow which is used for the purpose of valuation, not only in case of businesses for organic growth or inorganic growth, even in case of the fixed income securities. And remember, the fixed income security, the size of the fixed income securities across the globe is more than $150 trillion. $150 trillion is the size of the fixed income securities. So for all the assets, we have to use the discounted cash flow method. So how does the discounted cash flow method works? Let us understand it step by step. Step by step. So now the step number one is ascertain the explicit forecast period and the terminal period. And that is what I have mentioned to you already. How would you determine the explicit forecast period or the terminal period? As far as your exam is concerned, it would be given to you that this is the explicit forecast period and this is the terminal period. And therefore your life is much easy and simple. But
Can I put an example?
yep, you want to say something?
No. I mean to say, so how to, can I put an example?
Oh, please go ahead. Please go ahead.
Basically, suppose the contract, he is securing contract from the government to go for establishing solar project in different state.
Mm-hmm.
Okay, it is now a requirement of the day and people are going.
Mm-hmm.
But after 5 years, the demand of the solar light or solar generation electric will be little slow.
Mm-hmm.
So for next the first 5 years can be taken a very high growth, and for next 5 years, subsequent 5 years will take it very static growth.
वेरी ट्रू जैन साहब, बिल्कुल सही कहा आपने, बिल्कुल सही कहा आपने, बिल्कुल सही कहा. एंड दैट इज द पर्पस ऑल्सो ऑफ द टू स्टेज discounting model. Now please remember, as I said earlier, because those two things which I have mentioned to you, please remember, are the real mantra. They are the cornerstones of the discussion. And what those two things are: number one, what is value? Value is utility of an asset.
Utility of an asset.
Yeah, value is utility of an asset. So if I am investing money into a company, then what is my value from this company? My value from this company is going to be based on the utility that I have from this company. And as a business, what is the utility that I will have from this business? As a business, I will have the cash flow generated from this business as my utility from this business. And therefore, if for first 5 years, suppose the government is going to give me a rate at the rate X rate, and after 5 years the government is and for the rest of the life the government is going to give me the rate at the Y. That means for first 5 years it is going to be my explicit forecast period where my return is going to be higher, and after that 5 year period starts the terminal period where my returns are going to be static. So that, of course, you are right, and your example that you have given is also correct, actually, absolutely. Okay, so that's number one. Stage point number one is divide. And how do you divide? You divide in consultation with the company, because remember, as valuation professional, we may have a knowledge of valuation, but we may not have the knowledge of every business or every industry, and therefore we have to depend on the company and also other outsiders. So we get to know from the company as to what is the growth that you expect for this company to happen, and based on that you take that decision. Stage number two, or point number two, step number two, estimate growth rate in earning during the explicit forecast period and during the continuing period, which is also known as terminal period. So again, you will be able to figure out as to what is going to be the growth that this company will have during the explicit forecast period based on your understanding, knowledge and expertise and experience of the past valuations. If you do not have this, then of course you can talk to the company and find out from the company as to what kind of growth do you expect during the explicit forecast period, and what kind of growth rate do you expect during the terminal period. And then of course you have to consent to it, you have to agree to it. So that means whatever rate that they are telling you, it should be palatable to you, because ultimately you are doing the evaluation. So that is what you will do. That is step number 2, that is find out the growth rate during the explicit forecast period and also during the terminal period. Step number 3, एस्टिमेट दी प्रोजेक्टेड फ्री कैश फ्लोज. सो जैन साहब, जो आप बीच में आपने एक जिक्र किया था कि ये जो प्रोजेक्शंस बनाएंगे, आर दीज प्रोजेक्शंस गोइंग टू बी मेड इन दी सेम वे as you would make them normally for any other purpose? And the answer of course is yes. Answer of course is yes, because ultimately projected financials are what they are. Doesn't really matter as to what purpose do you make them for. So आपका जो प्रोसेस है, मेथोडोलॉजी है, वो सारा सेम रहेगा. जो कि आप एक कैपेक्स के लिए अगर प्रोजेक्ट कर रहे हैं तो सेम प्रोसेस रहेगा. सो एस्टिमेट द प्रोजेक्टेड फ्री कैश फ्लो during the explicit forecast period, and of course for the terminal period. That is what you will do. So which means what? Which means you as either the company will give you this information and then you will verify and satisfy yourself, or based on your understanding and knowledge you can do this forecasting, and you can prepare the projected cash flow. So that means what is going to be the income of the company, what are going to be all the expenses of the company, how much is going to be the amount of depreciation, amortization, how much is going to be interest cost on working capital, interest cost on the capex, on the project loans, and how much is going to be the taxes and things like that. So all that you will need to prepare, and that is estimate the projected free cash flow. Why projected free cash flow? Please remember, ultimately valuation that you will arrive at using the discounted cash flow is going to be based on the free cash flow. Free cash flow meaning the cash flow which is available with the company to be used for anything that they want to use it for. So that is what you will do. In estimating the projected free cash flow, you only have to take one precaution. And what is that one precaution? That one precaution is make sure that the projected cash flow that you are making is not too flowery, not too over optimistic, and not too pessimistic. It must be as realistic as possible. Why it has to be as realistic as possible? Because what you are trying to do as a valuation professional, you are trying to find out the fair value as a valuation professional. So if your valuation, if your projected cash flow itself is distorted on the higher side or on the lower side, obviously the fair value or the value that you would arrive using this free cash flow will not be fair. So that is the only precaution that you need to take, that is make sure that your projected cash flow are as close to the reality as possible. Now number 4, yeah, okay, all right. Number 4 is determine the cost of capital. Now before we discuss about the cost of capital, let us also understand, remember your cash flow, your free cash flow can be free cash flow for the firm, or it can be free cash flow for equity. No rocket science, no earth-shaking difference. The difference between the free cash flow for the firm and free cash flow for the equity is very simple. And what is the difference? Difference is free cash flow for the firm would mean cash flow which is available for the benefit of all the capital providers. Cash flow which is available for all the capital providers. That means the cash flow which includes earning after tax, cash flow that includes depreciation and amortization, cash flow that includes dividend on the preferential share capital, cash flow that includes interest on the short-term borrowing, long-term borrowing. All this cash flow is known as cash flow for the firm. That means cash flow which is available for all the capital providers. And then you have a cash flow for the equity. Now what is the meaning of cash flow for the equity? Meaning of the free cash flow for equity would simply mean the cash flow which is available for the benefit of only the equity shareholders. That means from the free cash flow for the firm, if you minus the interest, if you minus the dividend, what would remain is the free cash flow for equity. And that is what you need to understand. Please remember, and once again, because when you're doing valuation, what you're trying to find out, you're trying to quantify utility of a business in terms of money. You are trying to quantify utility of a business in terms of money. So if you are doing valuation of a business, you can do the evaluation of a business as a whole, or you can do the valuation of a business for the equity holders, right? So if you're doing valuation of a business, which is also known as enterprise value, if you're trying to find out enterprise value, you will have to take the cash flow, which is for the firm. And if you're trying to find out the equity value, then you will have to take the free cash flow for only equity. And that is what you should remember. Now, point number 4 is determine the cost of capital. Now, please remember, discounted cash flow meaning what? Discounted cash flow meaning you have to discount the future cash flow. And why you want to discount the future cash flow? You want to discount the future cash flow so as to arrive at the present value. Now, if you have to discount the future cash flow to arrive at the present value, you will have to discount the future cash flows. So if you have to discount the future cash flows, you will have to use a rate, which is your cost of capital, which is your cost of capital. Now, here please remember, number 1, in case if you are using, if you are trying to find out the enterprise value, in case if you are trying to find out the enterprise value, you will use the free cash flow for the firm. And if you are using free cash flow for the firm, then you will discount this cash flow, free cash flow for the firm, you will discount it by the WACC, weighted average cost of capital. That is number 1. Number 2, if you are trying to find out the equity value, so to find out the equity value, you will have to use free cash flow for equity. And if you are using free cash flow for equity, you will discount it by cost of equity. And that is what you have to remember. And why do I say this? Because in the exam, in hurry, you can make a mistake. So if you are trying to find out the enterprise value using the free cash flow for the firm, and you are discounting it by the cost of equity, your answer is going to be completely wrong, and vice versa. You're trying to find out the equity value using the free cash flow for equity, but for the purpose of discounting, you are using the WACC. So your answer is going to be completely wrong, and that is what you must remember. So determine the cost of capital. And determining the cost of capital, remember, in case of cost of debt, it is very simple. Any debt that you have is very simple. The rate of interest minus the tax benefit that you get because of interest being a tax deductible expense, that becomes your cost of debt. Cost of equity, there is no way to determine exactly as to how much is the cost of equity. But if you really ask me, what is cost of equity? Cost of equity is nothing but the expectation of the investors, expectation of the shareholders. But there is a problem. What is the problem? The problem is listed companies or big companies will not have one shareholder or two shareholders. If listed companies or big companies were to have one or two shareholders, you can simply go and ask those two shareholders as to what is your return expectation from the company. Whatever return expectation that they tell you, you can take that as the cost of equity and find out your WACC. But there are hundreds and thousands of shareholders nowadays. So how do you find out the cost of equity? For finding out the cost of equity now, friends, you have a model which is known as capital asset pricing model. So capital asset pricing model will not give you the exact cost of equity. And why it will not give you exact cost of equity? Because if it has to give you exact cost of equity, then you must know what is the exact cost of equity. Then only you can find out. Since you do not know what is the cost of equity, that is why you are using the capital asset pricing model. Capital asset pricing model will give you a cost of equity which is quite reasonable, dependable, reliable, and as accurate as it could be. Why? Because the capital asset pricing model takes into account all the factors. It takes into account the free rate of return, it takes free rate of interest, risk-free rate of interest, it takes into account the risk of a business, and it also takes into account the market premium. So that is why you use the cost of capital for the purpose of determining the discounting rate, and that's your point number 2. Now, having done the point number up to point number 4, so what you have done, you have made the you have calculated the projected free cash flow for the firm or for the equity. You now also have the cost of capital. Now you come to the point number 5. Point number 5 meaning what? Convert the cash flows, the future cash flows, using the cost of capital in terms of present value. So first you will find out the present value of the explicit forecast period, and then you will find out the present value of the terminal period. When you add them together, that becomes the value of the business. So if you have used, I'm repeating once again, please pay attention. If you have used the free cash flow for the firm, discounted them by the WACC, then what you will get is the enterprise value. If you have used the cash flow for equity, discounted it by the cost of equity, then what you will get is the equity value. So that's your point number 6. And point number 7, make adjustment to the discounted cash flow for non-operating assets or liabilities. So please pay attention. Using the discounted cash flow, I'm just giving an example and pay attention. Using the discounted cash flow method, you have come to value of a business as 1000 crore. Using the discounted cash flow method, you have come to a figure of 1000 crore as value of a business. And my question to all of you is, now you are told that this company is also having a piece of land in Pune, and value of that piece of land is 50 crore. So please tell me, all of you, what would you do with the value of this land of 50 crore?
You will add up.
You will add up. And why will you add up, Jain sir?
It's a thing. It's an asset of the company.
It's an asset of the company. And remember, all of you, why will you add it? You will add it because the value that you have arrived at, using the discounted cash flow method has not factored this land which is lying in Pune of the company. So the discounted cash flow 1000 crore is coming from the operations of the company. This land is outside those operations. And therefore, what is the value of the company today? The value of this company is 1000 crore, which is coming based on the discounted cash flow method, and 50 crore, which is the value of this land which is lying in Pune. So the value of the company becomes 1050 crores. So this is how, friends, you will, and when you divide this value by the number of shares, then you will get the per share enterprise value, or you will get the per share equity value. So friends, these are the stages of steps in using the two-stage discounted cash flow method. If you have any question on this, please go ahead, else we will move to the next topic. Any question, any doubt that any one of you may have on this, on whatever we have discussed so far, please go ahead and I would be very happy to take your doubt or take your question. Jain साहब, कोई सवाल आपका?
So that even for value of equity, we should add that property value, sir.
Can you please once again?
Said that we should add non-operating values to the value.
Yes.
Even value of equity, we should add the property value also.
Yes. Okay. So okay, tell me if I understand your point. So the point that we are discussing is, when you are using the discounted cash flow method and arriving at a value, and if you realize that this company also has some other non-operating asset lying somewhere, then to arrive at the final value of this company, you will need to add the non-operating asset lying somewhere to the value that you have arrived, so as to get the figure of total value of that company. That is the point that we are discussing. And
Sir, so suppose a company is having secured debenture and unsecured debenture. As well as, sir, other type of debt also. To derive the free flow to cash flow for the equity, how to take account the interest of secured is okay. So for the interest of unsecured portion, in the same coupon rate you have to take.
Yeah, okay.
You have to take the coupon rate of the LCD.
Yes, absolutely. See, Jain sahab, dekhiye, now it doesn't really matter whether a loan is secured or unsecured. Okay, because and why doesn't matter? Because you are looking from the perspective of the company, and and please pay attention. And in any case, if it is unsecured, you would have obviously agreed for a higher coupon rate than in case of a secured loan where you would allow little lower coupon rate. So that aspect is taken care of in any case. And number two, when we are doing valuation of the company, we are looking from the perspective of the company, or we are looking from the perspective of the company as to how much is the cash, free cash, which is going to be available. And because that is the value, that is the basis for us to arrive at the value. So an asset may be secured or unsecured. It doesn't have any uh, additional bearing, except that secured debt will be at a lower rate of interest, unsecured will be at a high rate of interest.
Okay, other than the fixed asset,
Hmm.
any other item to be added while deriving in the
Very good, Jain sir. Very good. अब देखिए now sometimes you will need to look at as to how much is the cash that company is carrying, and you will have to analyze that suppose if a company is carrying a cash of 40 crore, and when you do the analysis and you realize that as far as the company's operations are concerned, a cash balance of 10 crore itself is sufficient. That means this company is carrying surplus cash balance of 30 crore. Are you with me? Because this additional cash balance of 30 crore is not contributing to the operational performance of the company. And therefore, in principle, whatever may be the amount of surplus cash, you will have to add to the value. Number two, a company may be having, let's say, short-term securities as investment or short-term investment. Now that short-term investment, in case, I mean, let's say, in case that short-term investment is giving you some return, okay, and that return you have factored into your cash flow, then you do not have to worry about.
okay,
But if that cash, the current investment that you have, and you are not certain of as to what return this is going to generate, and therefore the cash flow that you have made, in that cash flow you have not factored the return from these short term investments. So now when you arrive at the value, what value of the business, you will add the total of the total of the current investment that you may have in some security, debenture or whatever. You will have to add that amount also to the
okay.
pen.
Like if, that means
Yeah.
in case of drawing a valuation on income factor basis,
Right.
not necessarily that value is the final value. You have to take other
Oh
things also
yes.
into consideration.
Oh yes, yes. You have to make a lot of adjustments. You have to make a lot of adjustments. So, or you will have to, as a professional valuer or valuation professional, you will have to look at with a magnifying glass as to is there something that I have omitted in my working. So if I have omitted that in my working, I need to bring that also and factor in my final valuation figure. Now, all this that I am sharing with you, of course, is going to help you in your exam as well, because sometimes the questions are tricky and they might check you on these issues. But this will definitely also help you in your practice whenever you start as a valuation professional. All right, friends. So if there are no other query, what
Sir,
we can please.
can you explain unlevered free cash flow?
Unlevered free cash flow. Okay. So you know what is lever?
No, I don't know. I have read that term somewhere. That's why I have asked.
You know what is financial leverage?
It is something to do with debt.
It's something to do with debt. That's right. That's right. So, uh, a company may have a debt, or company may not have a debt. So, if a company is having debt, that means this company is a levered company.
Okay.
Okay. So, this company is a levered company. That means this company is using debt. So, the cash flow of this company is going to be levered cash flow. And a company which does not have debt, the cash flow of that company is going to be unlevered cash flow.
Okay.
Yeah.
So to arrive to unlevered free cash flow, we have to add the interest component.
Yes, that's right. Absolutely. Absolutely. So, see, it's like this. It's like this. In case of a company which is having a debt, so this company is having debt, and that means this company will be paying interest. So the cash flow of this company is going to be a levered cash flow. Now, if you want to make it unlevered cash flow, so then what you will need to do, you will need to add the amount of interest back to the cash flow, so as to arrive at the unlevered cash flow. I hope that answers your query.
Yes, sir. Thank you.
Okay, good. So, friends, what we can do, we can take a quick break of 5 minutes and a comfort break of 5 minutes. Now it is 5:35 in my watch. Sharp at 5:40, we would come and start from here. Now, what we're going to do, we will be now discussing the next topic, and next topic again is something very interesting, and that topic is of valuation of intangible assets. So see you in next 5 minutes. See you in next 5 minutes.